Let's turn now to a look at the broader markets as investors gear up for results season. We have joining us now Seema Shah, Principal Asset Management Chief Global Strategist. Seema's here with us in studio today. It's good to talk to you today. It feels like we're finally kind of able to pivot a little, if you will, looking at earnings season with the big banks reporting later this week. But what do you have your eye on in terms of what's driving the market right now?
So we continue to think, of course, about the Federal Reserve and what's going on there. Increasingly, we're getting a lot of questions about the dollar. How is that going to impact the rest of the world? And even could that influence Fed policy going forward, which actually we have to say, we think that the Fed stays very much domestically focused. With regards to earnings season, the thing that we have seen is this year, top-line earnings growth has been incredibly strong. It has managed to beat expectations time and time again. But we're getting towards the end of the year when you are expecting to see economic weakness start to seep in. But it probably won't start to show through until early 2023. So this could be another solid quarter.
Yeah, in terms of the narratives we're expecting during earnings season, obviously a lot of sort of similarities in terms of threads. FX headwinds, a key one that we've been watching. Also just where the consumer demand is right now. What are your biggest concerns?
Well, I think the FX headwind is an important one. You are seeing that companies which have a lot of international exposure, so those which are exposed to Europe, of course, China, emerging markets, they're struggling because their economies are also slowing a lot quicker. Throw on top of that the strong dollar policy, the strong dollar outlook, and of course these companies are being additionally challenged, so their margins are being compressed further and further. So that's one thing they're watching, but also the consumer resilience is really interesting. And I think that what we're expecting to see is until you see US labor market weakness really start to get going, actually the consumer could stay quite resilient. We know that there's a headwind coming, but it's not quite here yet.
We're still a few weeks out from the next FOMC meeting. We had a New York Fed survey come out today pointing to inflation expectations declining in the short term, but increasing in the medium and long term. We've got the CPI print coming out later this week, but what is your read on where we are when it comes to inflation?
We have still very, very far to go. We're hoping that we have seen peak inflation. The energy prices are still very much a wild card. We assume that they're going to keep coming down, but as we've seen over the last week, that's definitely not a guarantee. Now, even if that peak is behind us, it's not enough relief really, because we do think that the decline from here is going to be extremely slow. We can see that core commodities, core transportation, those segments of inflation probably will turn deflationary. But it's the stuff like shelter inflation, medical services, those parts which are very, very sticky. And once they start to get going, it's very difficult to contain them unless you can create economic weakness. So from the Federal Reserve's perspective, they almost have to engineer a hard landing in order to contain inflation. So that means bringing rates up further, keeping them high for pretty long, so higher for longer. And only at that point can then we start to see some kind of relief on the inflation side.
You said they have to engineer a hard landing. Some still holding out hope that it won't be quite as severe, but it sounds like you think that's a necessary step to get inflation back to where the central bank needs it.
Exactly. I think a soft landing wouldn't be sufficient. I mean, what the Fed needs to do is create labor market slack, increase labor supply, almost make things so difficult that people have to return to the labor market. And by doing that, you reduce wage pressures. But in so doing, of course, you make the economic conditions extremely challenging. But this is your price reset. It's the only way you're bringing down inflation.
Has the pace of the rate hikes been sufficient for you? I mean, there's some that would argue that it's going too quickly. Yes, they need to hike rates to get the labor market in check, but more importantly, inflation as a whole in check. Are they moving too quickly?
I would say, look, they started off very slowly. I mean, the fact that they started off with a 25 basis point hike in retrospect seems a little bit crazy. But at this stage, I think they do need to move very quickly, but they do, of course, risk the fact that, given the lag from monetary policy to actually hitting real economy, you do risk an even deeper slowdown than what they necessarily need to achieve. So it could be slowed down, but of course, when you have an inflation problem this serious, it's important to get in front of it and really front load your rate hikes in order to make sure that the inflation problem just doesn't continue to grow.
Really quickly, a lot of people looking at their portfolios right now saying, well, what do I do in this environment? In terms of how much cash you set aside, has that calculation shifted as a result of the volatility that we've seen?
It's interesting, actually, because I've been traveling around the US over the last week, and the question we keep getting from clients is actually, when are we going to be ready to put our money to work? Right? So everyone's starting to look already to when does the market reach its floor and where do we go from there? So from that perspective, it's really important to have that kind of liquidity in your portfolio so you're ready to deploy it as soon as those opportunities arise. So there is a concern about volatility. So in the run-up, it means about playing defense, going high qualities. We do like long-end treasuries, even securitized debt, which has a better relationship within economic conditions than what you see for investment-grade credit or even high-yield credit. But really, the opportunity set, which is the best, is still real assets. This is a high inflation, low growth environment. Real assets can continue to perform well at that point.
Okay, a lot of people taking notes right there. Seema Shah, Principal Asset Management Chief Global Strategist. Thanks so much for joining us today.